So most of the indicators point that we are like early stage recession or late stage expansion. And so a lot of the leading indicators like, conference board leading indicators, purchasing managers indices, those things are rolling over. Industrial production's rolling over. Inflation adjusted retail sales are rolling over. And the strong area, as you point out, has been the labor market. Historically, that is a lagging or coincident indicator, meaning that by the time unemployment is rising, you're usually already in a recession. And that's part of the reason why those two negative quarters weren't kind of a full recession is because unemployment was still pretty low and not really worsening yet. Even in the labor market, though, we're starting to see that some of the early indicators there are not looking good. So, for example, if you look at overtime hours, those are on the downtrend. If you look at temporary help, that generally is a more volatile and leading part of the overall labor force. Because imagine if you're a small business and you're running into tight times, you might reduce your temporary help service before you would let go permanent employees. And so those are actually down year over year. And so basically there are multiple small signs that the labor market's cracking, which combined with all the other indicators, inverted yield curve, contracting PMI, it kind of points towards likely recession. But I think we're still in the kind of the either the pre-recession stage or they always declare a recession months after it happens. So it's possible that this is like already part of the recession. But if it is, we I think still really early stages. Yeah. So 2022 was a story of earnings multiple contraction. So it's not like earnings went down yet. Basically, you had some non-energy earnings fall a little bit. That was offset by energy earnings. So overall, S&P 500 earnings are currently fine. But you had because you had a sharp rise in interest rates. You had a sharp reduction in valuations. And one simple way to think about it is if usually the 10-year treasury is like the benchmark that you compare equities against, right? If you can get a 6% yield on a 10-year treasury, you might look at equities and say, I'm only going to invest if I can get 5% better than that, right? So I want 11% expected returns. Therefore, I need to buy them pretty cheap if I want to comfortably beat the treasury. On the other hand, if the treasury is yielding 1% and I still want a 5% equity premium, I might buy equities even though I only anticipate that they're going to give me a 6% return, and therefore I'm willing to pay more like a higher earnings multiple, lower dividend yields, things like that. And so as you've seen a sharp rise from your zero yields all the way up to well over 4% at one point, that put a lot of downward pressure on equity valuations, especially growth-oriented equities. And I think that part of the story is now largely behind us. And the question for 2023 is, are corporate earnings themselves going to be very weak? And I think that, I don't think they're going to collapse, but I do think that they're going to be weak. So a lot of people have been surprised at how much the Fed's been able to tighten. Somewhat me as well. Basically, if you would have asked me a year ago, would I think the Fed would get this high, this quickly, I would say no, probably not. But if you do it fast enough, you can get away with it for periods of time. I mean, if the Fed just came out and said, interest rates are 7% for one day tomorrow, it's not like all these companies go bankrupt. It's about both the height of that interest, and then it's also about the time spent at that interest level. And that's because a lot of debt is fixed rate. So homeowners have 30-year mortgages, corporations have 5, 10, longer bonds. Government also has a range of maturities averaging 5 or 6 years, but it ranges from almost instant to 30 years. And so when they sharply raise interest rates, that only starts affecting the marginal debt that comes due and then gets refinanced. So if you just leave that interest rate where it is quarter after quarter, that starts to impact more and more and more types of debt, even though you're no longer raising the interest rate. And of course, another factor to consider is not just the nominal rate, but also positive rates, right? So if you look at some emerging markets like Turkey, I mean, if you have this, I don't have the numbers in front of me. Let's say you had 80% inflation and you had 40% interest rates. Is that tight? Of course not, right? So that's very loose. So a less extreme example is that if you have 7% inflation and you have 5% interest rates, are you tight or are you loose? And the answer is that you're actually pretty loose. And so real yields are still negative in many ways of looking at it. Now the challenge there is that there's multiple ways to measure real yields because CPI is apparently a lagging indicator. It's backward looking, rates are forward looking, and so it's hard to do that apples to apples comparison. So there's things like break evens, which are basically ways to measure the market's assessment of forward inflation. But then the problem there is that it's usually very inaccurate. And they were not expecting inflation that we got in 2021, 2022. And so right now, overall, we're still not that tight relative to inflation, although I think we're getting tighter as inflation comes down and as we stay at these tighter levels for longer. I've seen a number of people kind of report on that. I think somewhat incorrectly. There's a nuance there. So basically, inflation is always measured year over year, but the question is, what basket are you measuring inflation by, right? And that's always been a long-term controversy with CPI, which is essentially that you buy a basket of goods and I buy a basket of goods and services, and our baskets are not identical. You might spend more in one category, I might spend more in another category, and so if we calculate our personal inflation rates, they would not be identical. That's like Michael Saylor's quote that inflation's a vector, not a
Mhm.
scalar. It's like the mathematical way of putting it. And what the CPI tends to do is say, okay, what is the average American's basket of goods and services? If we do all this research and say, what is the average basket? And of course, the basket changes. If you looked at a basket in the 1970s, it's different than the basket today.
Right.
They didn't have laptops that we're like talking on, and so basically they regularly update the basket that they use as representing the what they calculate CPI by, and they used to use a longer rolling period to determine what they're actually going to how they're going to weight that basket. And what this announcement says is they're only going to look past the last year, which means that the basket changes more rapidly, and that can actually sometimes result in lower measures of inflation, or it can result in higher measures of inflation.
Mm.
So, for example, during the COVID shock, the lockdowns, people stopped buying services. They stopped going to restaurants. They stopped flying. They start buying electronics. They start remodeling their home more. They consumer durables. You had this like mismatch, and then everybody comes out of the lockdown. They all start flying. They all start going to restaurants, and then they stop buying consumer durables. Right. So services are now having inflation, and so that actually it will affect the numbers around the margins, but I don't think it's going to have this big like 1 month effect that I've seen some people report on. If they're only looking at the past year, they're actually going to look more at services, and in some ways, those are hotter right now. And so it actually might not even result in a lower metric. I think you'd have to go down the actual. You'd have to
Mm.
compare that basket. I think it's one of those things where in the near term it won't have a significant effect. Around the margins, it will. Um, and if you want to ignore the effect overall, I would just keep looking at money supply, right? Because money supply is, flat to down over the past year after being explosively up over
Right.
the past 2 years. And so I think any way you measure it, you're going to get, a decelerating inflation, this year until there's again some sort of policy shift. So we had a policy shift all last year, and I think we're going to be kind of in this period for a while until there's another policy shift. So there are a lot of different ways to measure how much money is in a given fiat system, because there's this big fractionally reserved system. There's multiple layers to it, and the cleanest way to think of it is base money and broad money. So base money is the kind of the lowest form of money, and that consists of physical dollars in circulation, as well as things like the reserves that banks have at the Fed. So it's core money. Then from there it gets multiplied. It gets fractionally reserved and multiplied into broad money. And so broad money it still includes physical dollars, but then it also includes for the biggest component by far is bank deposits. So for example, you and I might have a bank account. We hold our quote dollars at the bank. It's an asset for us. It's a liability for the bank. They hold their cash at the Fed, which is the asset for them, and it's a liability for the Fed. And broad money is much larger because, of course, banks don't have all your money just sitting, like in a vault in the bank. They're lending it out. They hold a number of assets that exceed their liabilities, but those
Hmm.
assets are not just dollars. They're mortgages, they're bonds, they're all sorts of different things. And so they actually only hold a small percentage of that as cash at the Fed. And so when the Federal Reserve does quantitative easing or quantitative tightening, they directly affect the base money, and to a lesser extent, they can affect the broad money. Whereas broad money is largely affected by whether or not banks are lending money, and how big the fiscal deficits are. Those are the two big levers that affect overall broad money. And so what this shows overall is that in 2020 and 2021, you had a big increase in broad money, which was very different than 2008. So in 2008, you had a big increase in base money, but not broad money, which is why it wasn't nearly as inflationary. You basically just recapitalized the core of the system, not the periphery of the system. Whereas in this period, because there was so much fiscal stimulus, banks checks went right to people's accounts. their actual spendable money went up substantially.
Hmm.
And so more money chased roughly the same amount of goods, and you got inflation. But because now the Federal Reserve doing quantitative tightening, because fiscal stimulus, there's no more like, those like fast acting types of checks flying around, PPP loans that turn into grants, things like that. Now you're getting this like flatlining and even marginal contraction of the amount of bank deposits and other measures of broad money in the system.